Hello, and welcome to the Waterfront Balanced Strategy Update. As 2023 comes to a close, we wanted to take the opportunity to update you on the performance of the strategy, give a little detail on its current positioning, and talk briefly about the outlook for the rest of this year and into 2024. So the balanced strategy is just over 9 years old. The objective is capital appreciation with current income. The capital appreciation largely comes from the allocation to equity, and within the equity sleeve, I invest in profitable companies trading at reasonable valuations. And I believe that investment philosophy is one that will compound very attractive returns over time. The fixed income sleeve is focused on capital preservation as well as current income. And increasingly, in the environment we're in today, that current income is quite attractive. So as we move to the next slide, you'll see the performance of the strategy over the last 9+ years now through October 31st. Over the last 9+ years, on an annualized basis, the Waterfront Balanced strategy on a net basis, net of fees, has returned a little over 6%, which compares pretty attractively to the S&P 500 and the Bloomberg U.S. Government Credit Index. Over the last 3 to 5 years, the strategy has performed very competitively versus its peers in the Morningstar moderate allocation category. However, on a year-to-date basis, and over the last 12 months, the strategy is more or less in line with its peers and is pretty meaningfully trailing the S&P 500. And so I'd like to talk a little bit about why that's happened. Before we get into some of the specifics, the current allocation of the strategy is quite conservative. About 50% of the portfolio is invested in equity, with the balance in fixed income and cash. As a reminder, that's right at the bottom end of the range that I'm committed to staying in, which is having equity at 50 to 70% of the total portfolio. On the equity sleeve, you'll notice that the strategy continues to have characteristics that have been consistent over the last 9+ years that I've managed the strategy. The factor exposures continue to be in a similar place. And I will highlight that it might surprise you that the strategy is overweight leverage. The reason for that is the leverage factor is inversely correlated to the earnings variability factor. And the companies that I invest in tend to have relatively stable earnings, hence an underweight to the earnings variability factor. The companies that have more stable earnings are able to have more leverage on their balance sheet, which improves their return on equity. And that's why the strategy is overweight leverage relative to the S&P 500. The fixed income sleeve continues to be pretty conservatively positioned, very conservatively positioned, with the vast majority of its credit exposure, roughly 96% of its credit exposure, to either government guaranteed credit, both treasuries as well as agency securities, or investment grade rated credit. Very modest exposure to high yield. Its duration position is just short of the benchmark at just over 5 years. So the benchmark's at about 5.9 years. However, its yield is quite attractive at just under 6% versus its benchmark that is closer to 5.5. And as I previously mentioned, the credit exposure is very modest. On the right-hand side of the screen, you'll also see the top 10 holdings of the portfolio in total. On the next slide, we'll dive in a little bit deeper into each of the sleeves. So you notice the equity sleeve is very well diversified across sectors. The top 10 equity holdings and the percentage of equity is in the bottom left-hand part of that slide. And on the right-hand side, as previously mentioned, the credit exposure in the pie chart is heavily tilted toward AAA or investment grade rated plus securities with a very modest exposure to high yield, which are BB and single B rated credits. The key rate exposures of the portfolio relative to the benchmark are overweight the 3-year and 7-year maturities, and pretty significantly underweight the 30-year and 20-year maturities. And the reason for that is, as you likely know, the yield curve is inverted, which makes the longer dated maturities relatively less attractive in my view. And hence, I've been focused on that 3-year and 7-year part of the market. On the next slide, you'll see a brief overview of the equity market and the performance on a year-to-date basis. And I want to highlight this slide because it has an important, I think, read through and helps explain why the performance of the strategy on a year-to-date basis is not as attractive as it has been over time. On the left-hand side of this chart, the graphic is showing the return of the S&P 500, which is up roughly 11% on a year-to-date basis. And that's using the S&P 500 market cap weighted return, which is how it's generally represented. However, on an equal weight basis, you'll see on this chart, the average stock in effect of the S&P 500 is actually flat on a year-to-date basis. And the spread between the market cap weighted return and the equal weight rated return is very unusual. Matter of fact, the spread hasn't been this wide in over 20 years. The reason for that, the driver for that, is on the right-hand side of, very right-hand side of this chart. You'll see the year-to-date performance of various cohorts within the S&P 500. So large capitalization value stocks on a year-to-date basis are actually down 1.8%. Mid-cap value stocks are down a little over 4%, and small cap value stocks are down over 6%. And on the opposite end of the spectrum, large cap growth stocks are up over 23%. And you can see, just looking at that chart, that investors increasingly are flocking toward the biggest companies with the best growth characteristics. If you peel that onion back one layer further, in the middle of the chart, you see those same cohorts within the S&P 500, but instead of performance, it looks at the current price to earnings multiple versus the 20-year average price to earnings multiple of each cohort. So large cap value stocks today trade at 13.1 times earnings. And that compares to, over the last 20 years, on average, they've traded at 13.7 times. It's kind of a busy graphic. If you move to the bottom half of that graphic, I think it's more helpful, which shows that current PE as a percentage of the 20-year average. And as you look at that chart, you'll see the same characteristics. Investors have increasingly focused on the biggest companies with the best growth characteristics and are seemingly indifferent to what they have to pay to buy those stocks. Those stocks are trading at over a 25% premium to their own 20-year average. One other point I want to highlight on this chart before we move on is that increasingly is creating opportunity in other areas of the market. As investors move away from and ignore move away from the small, mid, value, and blend parts of the market to focus on those few names that are driving performance, as you see on the left-hand side of the chart of the S&P 500 performance. As investors increasingly flock to that small cohort of stocks, they leave and are creating a pretty attractive risk reward in some of these other areas of the market. No one knows, I don't know, when that opportunity will come to fruition in the form of better performance. But clearly, increasingly, there is a pretty stark risk reward difference, in my view, between those favored groups of stocks in the upper right-hand part of that chart, those large cap growth stocks, versus the risk reward that we're seeing in other parts of the market. If we move to the next slide, there's also an increasingly interesting setup in the fixed income space. I'm going to start actually on the right-hand side of this chart, which shows the yield percentile rank currently versus the last 10 years. And this won't come as a surprise to you. We're seeing yields today in a variety of fixed income classes that we haven't seen in a very long time. Interest rates are much, much higher. And so the relative attractiveness of bonds today is very attractive relative to both its own history over the last 10 years in particular, but also relative to equities. And that helps explain why over 40% of the portfolio today is invested in fixed income securities. However, on the left-hand side of that chart looks at the spread percentile rank currently versus the last 10 years. So for the incremental risk that you take in buying US high yield or US investment grade rated credit, that spread versus the risk-free rate today is roughly in line or average versus the last 10 years. It's a little bit elevated in US investment grade at about 57%, but high yield is roughly in line with the last 10 years. And so for that reason, while I continue to emphasize fixed income, given the very attractive yields, I haven't moved aggressively into investment grade rated credit or high yield rated credit because of that spread differential. As those spreads blow out, I hope to take advantage of the opportunity and invest more aggressively in those areas. So to summarize, as I think about the setup currently and think about the outlook for the rest of the year, the Waterfront Balanced strategy is very conservatively positioned. The beta of the strategy is about 0.8 times relative to its blended benchmark of 60% S&P 500 and 40% the Bloomberg Barclays US Government Credit Index, which means that as economic growth slows, and I expect it to continue to slow both the rest of this year and into the first half of 2024, and as current forecasts for earnings and revenue growth for the equity market prove optimistic, I expect that to be the case. I think risk assets probably have more downside than upside. And as that volatility unfolds, and I expect that to unfold over the next 6 to 12 months, the balanced strategy should be less volatile than the benchmark. In addition, the risk exposure of both the equity and the fixed income sleeve continues to be relatively conservative. And as a more volatile environment unfolds, which I know is unsettling for most people, I want to remind you that it's that volatility and those pullbacks that create the best investment opportunities. And I'm expecting very attractive investment opportunities to unfold over the next 6 to 12 months. And this strategy is set up to be able to respond quickly and meaningfully to take advantage of those opportunities, which will drive attractive, I believe, attractive returns over the next 1, 2, 3, 5 years and beyond. And so as we go into the end of 2023, I want to take this opportunity to wish you and your family and your friends a very happy and joyful holiday season. I hope you're able to enjoy some restful relaxation and really enjoy the holiday season as it unfolds over the course of the rest of this year. I thank you for your investment in the Waterfront Balanced strategy, your interest in the strategy, and I wish you the best in the rest of this year and into 2024. Thanks for your attention.